So we've analyzed two properties, and I really want to go over something here. We've basically done is an initial analysis. This is the analysis that we use to determine the offer price. I use as much real existing numbers as possible. If they tell me the rent is this, I use the rent that they tell me. If they tell me the expenses is this, I use the expenses they tell me. If and then I use the 8% vacancy, 5% maintenance, and 5% capex. But there's also a pro forma analysis, which is basically maybe the previous owner has owned the property for 20 years and they have not been keeping up with fair market rents. And their rents are far below what you know is realistic. Maybe they're renting it for $1,000 a month. You know you can rent it for $1,200 a month. I personally do not make offers on the rent that I think it can get. I make offers on the rent that they're currently listing at. Once again, it's one of those things where you do that. I guess why compromise your investment goal? It's really up to you how you want to analyze it. That's the way I do it because I take what their numbers are at face value, but I also think, okay, maybe I can increase rent, maybe I can decrease these expenses, and that's what a pro forma analysis. So it's basically doing the same analysis, but with what you think is more realistic. Let's say their rents are too low or their expenses are too high or whatever. That's when you do that. But as I mentioned, I offer the initial analysis is what I offer my purchase price on. For example, if I think this property is so nice, it's going to rent very quickly. It's a 5% vacancy instead of 8% vacancy. I would include that as part of my pro forma analysis. Use the exact same tool, use the exact same calculator to do so, but you're just putting in numbers that you think are more realistic to the scenario, not the numbers that you were provided. Hopefully that makes sense. I just wanted to emphasize that. I added this in the last minute because you really want to, once you get more knowledgeable, you really want to understand that just because someone has been doing something a certain way doesn't mean that's the way you have to do it. But I wouldn't give the seller the benefit of the doubt and over offer a price that is based on your pro forma, not what's realistic. I mean, you have to actually put some common sense into that. If they're renting for half of what you think is realistic, okay, maybe you offer a little higher than the initial analysis price, but I personally don't ever offer the full pro forma analysis. Cool. So we're going to analyze a property of your guys' choosing, but let's do some Q&A before we do that. So maybe I'll stop screen sharing for a minute. Or actually, I mean, there's no reason to stop screen sharing. I will just allow, if there's any questions about anything that we've gone over, please let me know. I know it was fairly fast. In 1 hour, we covered lots of topics, went through a couple examples, and we'll do one more example of a realistic property. But please let me know if there's any questions right now. This is the perfect time to ask me, and there's other investors in this Zoom call right now that can help address questions as well. So please ask your questions. Don't be nervous about it. What you want to ask is probably what someone else is thinking as well.
So when you're doing your analysis, are you ever calling the utility companies and just getting the average for the last 12 months? Or do you just kind of wag it like you have been?
So initially, I go off of estimations. And then once I'm serious, I say, hey, Mike, my realtor, get me the MLS listing and any additional documents they have for that property. Usually, if someone's selling at least a multifamily property, they're going to give you a year, 2, 3 years of the most recent expenses. Typically, you see water and heat. Electricity, sometimes you get that, but typically, if it's a multifamily property, the renters are paying for that. So you can request that. And Mike, in every offer we say, every offer that we make, it literally says, if you accept our offer, we want within 24 hours or 48 hours, we want all the recent utility costs, all the leases, we want your actual profit and loss statement. We ask for all that stuff in the offers that we make, but it's not realistic to call a utility company every single time when you're doing the initial phase of analysis. You need some kind of relative placeholder numbers, and just understand that those are just placeholder numbers. They can wildly change your actual investment. If you're going to make an offer, I highly recommend you get the actual utility expenses, whether you call the utility company or you ask the seller directly for their numbers. Don't take an Excel sheet, take their actual utility statements. If they're selling the property, they more than likely already have all that put together. Does that answer that?
Absolutely, thanks.
Yeah, no problem at all.
And
because
Mike,
especially
if I can add to that.
Yes, please.
Yep. Hey, so this is Mike Garza again. So great question, whoever asked that one. One of the first things is if you call GVEA, which is the name for a local electric company up here, and you're just average Joe Blow saying, hey, I think I'm going to buy, 123, Taxi Street. What's the electricity on that? Look, they're not going to give it to you.
Yeah.
So you have to get it from a realtor or
Really?
hope that whoever, yeah.
Chugach and Instar will give you the average.
Who will?
Chugach and Instar. They give you the
Yeah,
average.
no, GVA up here won't do it, man. As a realtor, there's even a form that I got to get my clients, my sellers to sign to give me the authorization to get the history. But if I call in and I'm not the person that's on the bill, they're not going to share with me over the phone.
And honestly, I like our method in the sense of asking for the last 12, 24, 36 months of actual utility data, because there are definitely anomaly months. If you get an average, you're not going to necessarily see the anomalies that occurred. But let's say a property, the average is $100 a month for electricity, but through the last 12 months, that property was vacant. So electricity was $20. So when you account for just those 10 months that it was actually occupied, the electricity is going to be much higher. For this example, I mean, we're talking more heat and water primarily, but it's really good to see the granular data, that monthly data, and then take your own average and take out any data that seems just like, whoa, what the hell happened? Like I've seen one time, like someone's electricity is like $300-400. It's like, what happened? Oh, we kicked that tenant out because they had like all these space heaters and electric blankets and all that. Or, oh yeah, that property sat vacant for those 2 months. So that's why the electricity is only $20. Like you want to see that data and only include data that actually makes sense. I'm not saying pick and choose unnecessarily, but if the property is vacant or there's some ridiculous anomaly in that data, you want to kind of take that average from there. Cool. Any more questions? That was a phenomenal question, and that's really important. As I mentioned, placeholders are good to start off, but you want as much real data as possible, especially if you're going to make an offer.
I did notice that your closing costs, you stated that oh my Lord, anybody want any dogs? That you were calculated on 2.5% of the purchase price, but the actual calculation you had was one point something percent.
Oh, was it? Oh, okay, that was my bad. Yeah, I don't know. It should just be 2.5% of the purchase. Oh no, sorry, 2.5% of the loan. That's what the issue was. It's 2.5% of the loan is what it should be. Because the down payment, they're not going to charge you necessarily fees for that. And once again, that's a placeholder too. You put in those placeholders and then you actually get so that's like further down when you're really getting into the nitty gritty of your offer and all that. You want to make sure that you have a placeholder to analyze the property, but that's not 100% accurate. It depends on a ton of things. It depends on the bank you're working with first and foremost. It depends on your credit, yada yada. It depends on a ton of variables. You want to actually fill it in with what's realistic numbers. If you looked at one of my calculators, every single placeholder equation is replaced by an actual number for the most part. Like 80% of the data is replaced by actual numbers by the time I'm actually making an offer. But you need some numbers to actually be able to make an offer. Otherwise, you're just kind of sitting there, just waiting for data to fill in, which may not happen. But when you're already pre-qualified with a bank, if you say, hey, I want to purchase this property at this address for this amount and this is how much I want to put down, can you give me a cost sheet? They'll get you all that. And once again, that's also an estimate by them, but it's a much better estimate than you can do on your own. Especially if you're going to buy down points and all that. These placeholder calculations are not going to account for anything like that. And same with the interest rates. Those are all placeholders too, based on kind of what I'm seeing in today's market. Cool. Any other great questions like that? That's a good question. This is your chance, especially I know we got a couple newbies in here. I mean, I was a newbie just not too long ago, and I've learned a lot over these last few years, and this is our chance, especially for those in some of our real estate groups. I know there's a lot of people who are kind of in this initial phase trying to get their first property. This is a great time to ask those questions, because not only are you going to get the answer, but you might be helping out another person who's interested in that. I'll wait just a few more seconds, and then we can analyze another property.
So, okay, I got a quick question. So for things like insurance that you're estimating, that's kind of something that you would, I guess, ask the previous owner for to get more accurate numbers?
No, you would talk to an insurance agent. You would say, hey, I'm looking to purchase this property. I want to cover 10% over the actual home purchase price. What is the cost for that? I put placeholders in there because you're probably not going to do that for every single property, but after doing it enough times, you'll get kind of a rough idea of what it costs you. That's kind of why I know, at least for me in my insurance provider that I use for landlord policies, they're charging me around for a 250 to 300 $250,000 duplex. They're charging me around $85 a month for insurance. For $300,000 plus larger property, it's going to cost closer to 120 a month. But those are estimates, and luckily it's not gonna be like $500 something crazy if you're just a normal regular person trying to get insured. So it's kind of all within a reasonable range. I'd say between 80 probably at the lowest end up to like maybe 150. I don't know what my fourplex is going to be when it's non-owner occupied, but I assume it'll be probably closer to that 150 range. Maybe let's say $40 to $50 per unit for insurance. I mean, maybe someone else can add more. I know Mike's real good with insurance, but this is what I've seen with my insurance providers.
I've used like 0.5% of the purchase price. It's a pretty good rough number.
Yeah. All right. So does anyone have a property that they would like to analyze? I have Zillow open. Well, I guess I will have Zillow open. And I will have my calculator open.
I just went under contract on 460 Hamilton. You want to throw that one in there?
Sure. All right, let me pull it up.
I'm sorry, 760. I said 460. My bad.
You say you just went under contract for it? I'm just kidding. It's all right. I couldn't remember the last one I couldn't remember the address at all. I was dyslexic with all the numbers for a while. It said 760 Hamilton.
No, you're good. Yeah, we did. Yeah, 760 Hamilton, Fairbanks.
Okay.
The fourplex as well.
Well, let's hope the returns are great, because and this is owner occupied for you? Or is this just an investment? Okay, we're going to analyze it as a non-owner occupied property, and then we can do it as owner occupied. Okay, let's just stick with the theme of
cool.
Okay, cool. So the really important part of this is it's no more screenshots. You actually see how to use this calculator, which I'm going to be sharing with you, so you can use it. Ask questions now about how to use a calculator. As it comes up, interrupt me if you need to.
I think I could feed you the information, Mike, if you need that. Versus
yeah, please. I got this sitting here.
I have a bunch of stuff in Word.
Okay, I got this sitting here, and I'm going to try to show how much of the stuff you can pull from the actual site itself. But yeah, definitely let me know. So first and foremost, and this is Tony, right? Who's talking?
Yeah, this is Tony, man. Sorry.
Hey, Tony. Okay, so we know it's a fourplex, correct?
Yeah.
Perfect. As I mentioned, we're going to analyze this as a non-owner occupied conventional loan, just to keep with the theme, and then we can actually analyze it as an owner occupied property afterwards. One thing I'll mention immediately, if you can see this photo, you see 5 meters here. So that automatically means to you, basically, if everything's wired like normally it should be, it's the 4 units and then 1 common area mechanical room or something like that, or a laundry room that you're going to have to pay electricity on. So that's something you should look for. You got to understand context clues while you're looking at properties, especially investment properties that are more than 1 unit. All right, so it says, and this is what you're going to see commonly too. It says 2 beds, 4 baths. We obviously know that's incorrect. Square footage might be true. That might be a pretty good. This one's got great. Looks like there was a lot of good upgrades in the last 10 years. New roof, furred out walls, increased insulation. That's great. It means your heat expenses are going to be lower since you're going to be responsible for that. It means all units have been updated with lights and flooring. That's great. So that means that they're probably turnkey and rent ready. What else? Capital expenditures are probably going to be low. So I'm going to estimate for upfront repairs and long-term repairs, $0 for right now. There's nothing urgent that needs to get done. You'll actually do your due diligence when you go look at the property and be like, oh, you know what? They said that, but we might need to replace these carpets, or we might need to do this. So either you ask the seller to do that as part of your deal, or you just account for that as part of your analysis. And is that kind of what you're doing, Tony? Are you just using this as basically turnkey properties?
Yeah, I am. It's about your typical fourplex. It had a lot of remodels and stuff, but it's, you know how it goes. They're a little
Yeah.
bit rough, but yeah, pretty turnkey though. Pretty minor
Okay,
stuff.
cool. So we're gonna go with, do you want to put in maybe $2,500 for upfront repairs or something like that? I mean, that's pretty insignificant per unit. Like one thing I do is I add humidistats into the bathrooms, which are it automatically triggers the vent in there in the bathroom when there's a certain level of humidity, because that saves a ton of money down the line and minimizes risk for mold growth. I think that's really important. They're approximately 100, 150 bucks a piece, including maybe the labor to install it. Plus, I change the thermostats to a landlord thermostat, which allows only a certain range of heat. It allows from 68 to like 73 in heat. So it means it's always going to be on in the winter, so you're not getting screwed and no one accidentally forgets to leave it on when they're on vacation and your pipes freeze, which we know is so important up here to make sure that doesn't happen. And then also, we don't have any reptiles living in our properties and they have 80+% degrees in their unit, because you're the one responsible for paying for that. But you don't want to be such a slumlord or anything that you're, at 60 degrees and you're having them freeze. But pretty much 73 degrees is a very warm unit, especially if it's insulated well. So, those are kind of things I automatically account for, and that could be accounted for a couple $100. So we'll just put like 2,000, which is 500 per unit for miscellaneous things we got to do. So we're going to go right off the rents here, because as I mentioned, you want to do this analysis based off what they're telling you. If they're telling you rents, I would definitely stick with the rents. I know Tony probably has plans for increasing these rents or potentially, but let's stick with what they have here. Tony, is there a laundry room here?
No laundry in this one.
Okay, so what are the unit sizes? What about unit 1 and 2? Are those 2x1s or 1x1s?
They're all 2x1s.
Okay, so
All
2x1s,
four
two of
of
them rent for 1,100. It's weird. Unit 3's for, maybe they were friends with that person. They've got one at 900. Oh, boiler power's on the unit. Got it. So I wonder what the 5th meter's for.
But
then,
there's 5 meters.
Yeah, so weird.
Yeah, exactly.
So yeah, so hopefully, I mean, we'll get rid of that to make it fair. We'll go off their numbers and we'll remove that from the fees down below for the electricity comment. Okay. So let's let this autofill. Okay, great. So now property taxes. The way I would do it is I would just look at what's on the website for now. If it's not available there, I'm sorry, Tony. List price, $359. Do you mind me asking, is that the price you agreed on, or do you want to just stick with that for the analysis?
No, yeah, we offered 360 and then we split closing costs with them.
Okay, perfect. So let's just do, all right, let's do exactly what you did. And then split closing costs. So I have that right here. Seller covers closing costs. So it takes that 2.5%. And then in here, it just divides that by 2. So it should be 9,000 and it divides that by 2 because you're splitting the closing costs. I think, maybe in the peak of the hot market, you're more than likely going to have to pay more of the closing costs. But we're already slowing down a bit. Going back to splitting closing costs is fair. And I know some investors who try to put as little money down as possible, they'll offer a higher listing price, but ask for the seller to cover all the closing costs since that has to be paid at closing. So, and there's certain rules about how much a seller can cover and all that. But on average, just assume split unless you negotiate something different. All right, cool. So in this scenario, we're going to assume 4.25% for this non-owner occupied investment loan. It's obviously higher if you're non-owner occupied. As Mike mentioned earlier, if you're not occupying the unit, everyone sees it as more risky. If you're not occupying it, the bank sees that more risky, so they charge you a higher interest rate. If insurance charges you higher rates, so that's just something you have to understand if you're not going to be living in the property, and that's fine. That's fair. All right, cool. So it automatically calculated the mortgage payment as $1,328. Your total upfront costs in this scenario are close to $100,000. We have rents up to $4,100 in this scenario. You have the, yep, there we go. And then taxes. So let's go down to the property details. It should be somewhere here. At least I know Zillow does it. 259. Okay, so it doesn't have it here. What we can do is I'm using the 1.18% of the purchase price to calculate it. $4,248. I think that's fairly close for the annual. If you really want, I'm not going to do it now, but you can go on the borough website and see what it recently, what was the most recent tax amount on it. I don't want to deal with how slow the computer's going, but for this analysis, or Tony, do you have a number we can put in there that's more accurate?
They're claiming $3,701. I think that's a little bit low. And I could tell you something interesting about taxes. The assessor's office will watch for places to come for sale, and that'll give them a chance to look at them inside and out. And they will make tax assessments on that, and they will catch them up if you're not careful. So I had a property that happened to. So word to the wise, if the taxes have been flat and you know there's been recent work and quite a bit of it, be prepared for those taxes to come up and account for it somewhat in your calculations off the bat, because I had that happen.
Yeah, and that's totally, actually, that's why my equation goes off the purchase price itself when it's determining what the property taxes are. Because I'm assuming the tax assessors are going to be lazy. They're going to say, what did this sell for? All right, that's the price we're going to charge for it. I've seen that happen more often than not. Same with your appraisal. It's like, wow, look at that. The appraisal, the bank's appraiser says that my property is worth exactly what we offered on it. Crazy how that works out, you know. They're always really close to it. And that's what I assume for property taxes as well. You can obviously challenge it and all that, but that's what I assume. All right, so Tony, for this property, what do you think, like 15, 16, or 150, 160 for insurance? What's your quote looking like?
Oh boy, what did I do for insurance here? I put 2,300 based off that triplex. But now after talking to Mike, but I use Country Financial, so you know, I don't know what my insurance is going to look like after that, because I just assumed it'd be commercial a little bit higher than triplex. So I put 2,300 a year.
All right, so that's making a significant difference in this scenario. All right, what's that, like 190? I'm just guessing and checking based off the annual. All right, 2,300. We'll just go 190. There we go. All right, water and sewer. This does not list any utilities on here. Any utility costs. Most do not include utility. Maybe they'll do an aggregate expenses. Maybe, but that's not likely. Typically, that's in the additional documents that they have listed on the MLS listing. The only way to get access to that is to be a realtor or know a realtor, and they can send it to you. Every time I like a property, the first thing I tell Mike, hey, Mike, can you send me the MLS listing for this property? I want to look through the associated documents to look for the expenses. These estimates are fine for a quick analysis, but they're not very realistic because every property is insulated differently. Every property, you want to get at the newest numbers or the most accurate numbers as quickly as possible in your analysis. And the first way to get that is the associated documents of the MLS listing. So you have to know a realtor for that pretty much. But for this estimation, or do you have any more realistic numbers than our estimations?
Yeah, so I'm a realtor also now as well. So I end up with 330 after I blended them all together over the past 12 months.
All the utilities or all the
water and sewer?
So I've noticed my waters are a little lower
because
my units have always been occupied a little bit under what you would. So a 3-bedroom occupied by 1 or 2 people, a 2-bedroom occupied by 1 or 2 people, not 3 or 4. So my utilities have historically been lower, and I need to adjust the way I account for that. But what I always do is I update it to what's accurate. So that's, they're only placeholders until then. All right. So what about heat? How close? I noticed heat is fairly close though.
Yeah, I put 350 a month.
Yeah. So perfect.
Fuel.
Garbage is the easiest. What?
Yeah. Hey, I was gonna say that's something for people maybe to consider is when you're looking at fuel, make sure one that you're looking at dollars, not gallons, because sometimes they will only put one or the other. Sometimes they put both. And the other thing is too, is depending on when they fill the tank, that could skew your 12-month window. So really pay attention when they're filling that. If they haven't filled it in the last 4 months or maybe that's not realistic, but make sure you're getting a full season out of fuel fill when you're looking at those documents.
100%. I try to get 2 winters at least up here of heat.
Yeah, I'll touch on that real quick.
That's probably better. Yeah.
And I'm fine with using gallons
so
because I use what's the realistic price right now. What is the realistic price for heat right now? I use that when I do my final numbers. So I take the gallons and I just multiply it by whatever the price per gallon is now, including delivery, because I know that's how I'm going to manage my property. Go for it, Mike.
And just to piggyback and on all of that. So typically when I'm looking at deals for Mike or anybody else in our REI group, you Tony, Mike, anybody else that's joined now, that we work together. Fuel, 2-year history minimum, if you can get it. Push for it. That's gonna be important. It gives you an idea of how much fuel they've been going through. But when you're factoring your numbers, I mean, I usually go with about $3 a gallon, because that's on average about what the rate has been over the past couple of years. I mean, we never know what the fuel rate's going to be next year. There are a lot of things that change factors on that, but get 2-year fuel history, 2-year electrical history if you can get it. And then always ask, and this is a common thing up here. It sounds like we've got some guys from the southern part of Alaska, but up here, what we run into a lot is landlords will sign a waiver for the residential disclosure. We call it in real estate, we call it an AS 3470. That's a statute number for it, but it's a 7-page questionnaire form that a seller is supposed to fill out to tell you what they know about the property. And for whatever reason, it's more common up here that they will have the realtor have them sign a waiver. And the waiver is really only used in 2 areas. One, it's a brand new build. There's no history to disclose. That's pretty obvious. The second one is they inherited. Crazy Uncle Jack moved up to Alaska back in the 70s. We never heard from him. He passed away, left us his duplex, triplex, fourplex. We don't want it. We're just going to put it on the market to sell. Those folks literally know nothing about the building. Another good reason to use a waiver. Outside of that, push for that AS 3470 residential disclosure. Even make it part of your contract, because there isn't a landlord out there, including myself, that doesn't know when I had to do maintenance on unit 1, when I had to do, change out, put a new well in, put a new roof on. All of those things are going to be important for you to know as you're making a decision to buy the property. So again, 2-year fuel history, 2-year electrical history, push for the AS 3470 residential disclosure, and try to get that, because that's going to help you run your numbers and make a more realistic offer when you present it. And then when you do present it, and I'm sure Mike will cover this, if you're presenting your offer for lower than what they're asking, you have some solid some documents and work that you've done to present and explain to them why you're offering so low.
Yep, 100%. Because I mean, if someone is selling the property and it's a multifamily property, that means they use it as an investment. Even if they lived in it the whole time, that means one of the units was an investment for them. And I have no shame in saying, hey, I'm also going to use it in an investment. This is how my numbers make sense, especially if it's around 5, 10, 15% down, because they understand, hey, I'm just trying to hit specific goals. And if that works, that works. If it doesn't, totally understood. In this market, it's a little harder to go below listing. The last one I got was exactly at listing, and we ended up even offering 1,000 more because we wanted them to do additional maintenance. But nonetheless, it really depends on market conditions. I use Rentometer to look at the average rents, because I know these 2x1 units are renting for less than they should be. But we're not going to account for that until the pro forma. We could account for that partially in the future, but let's do the analysis as is. So management is automatically done. It takes this equation here, takes 10% of the monthly rent goes to 10% of the monthly rent is automatically pulled, and then 50% of every 2 years is automatically pulled, because that's assuming turnover every 2 years. And I divide that by 12 to get your management. Most people just do the 10%, which would be $410 a month. I like to account for that turnover, because either you're accounting for that in your management costs. Well, yeah, that's the way to account. I mean, that's, in my opinion, the most realistic way. Ideally, you have a tenant that stays there for 10 years and you consistently increase rent to fair market value, but there's got to be some kind of, most people aren't staying, especially in a transient community like ours. Most people aren't staying for many, many years. I mean, most people are staying for 2 or 3 years at the most, because they're moving elsewhere. All right, and then our reserves is automatically calculated. I stick with the same 8, 5, and 5. It says that a lot of the expenses were done, or a lot of the recent, a lot of renovations were done. Maybe in the pro forma will decrease capex and maintenance a bit, maybe vacancy depending on the interior conditions. But this is how I would analyze it. So on the surface, this property as an investment property, not as a house hack, but as an investment property, brings in $4,100 in rent, mortgage and expenses of, let's zoom in a little bit. Can you all see a bit? Can you see the analysis right here? Or should I zoom in some more?
Yeah, we can see it.
Okay, cool. Your reserves of 738. Your cash flow is 197 a month. Your cash on cash return in this scenario is 2.45%. If you don't account for any reserves, your cash on cash return is 11.63%. I also calculate net operating income and cap rate, but that's not really necessary for you guys at this level. That's more when you're looking at larger than 4-unit properties. I still calculate it because it's simple enough. And net operating income is basically your rent. It's basically your cash flow when you don't account for your financing. So when you don't account for the mortgage, I calculate it. It's not too necessary in this case because there's too small of units to make sense. Yeah, whatever. In this scenario, this is something I wouldn't invest in as a outright investment property. But well, and then this kind of shows you where you should make an offer. But we know Tony is doing this as a owner occupied property, so it's very different in what he's gonna have to put down. Just like the other scenario, the more you put down, the more significant, the higher the upfront cost, the more significant effect is going to be on your cash on cash return. So it's important, to understand that with these non-owner occupied loans at these higher purchase prices, there's going to be a high upfront cost. You're going to have a significant cash flow to make that up. But when you do an owner occupied, you're going to put significantly less down. So your cash on cash return at similar cash flow, obviously your loan's going to go up a bit, but your similar cash flow is going to make a big difference. Realistically though, if I was doing my pro forma, I went on Rentometer. I saw 2-bedroom, 1-bath. My understanding, and this is pretty accurate for the market, the median is around 1050, average is around 1148. I'm renting them much higher than that. But for properties in a similar location to 760 Hamilton, they're renting for 1050 to 1148. I would say I am more of a median. I like statistics in terms of medians as opposed to average. But in this scenario, I would kind of go somewhere in the middle and say they're 1100 a piece. You have 2 that are already renting for 1100. I would probably increase all of them to $1100 in my opinion. I don't think there's any reason for them not to be at 1100 given 2 of them are renting for that, and that's what that fair market value is saying. Tony, do you have some insight onto what you think you would rent these for?
I think you're right there, Mike. I went low and high. I kind of took what they are, and then I said a possible top out of 1300, and I just ran complete cash flow numbers. I didn't because our lending option is only one. I didn't feel the need to go down the cash on cash return. So I ran a scenario of what they were currently, and I came up with cash flow numbers ultimately about $1,000 a month, 1,066, and then a possible 1,300 if we keep seeing increased rents. I kind of figured maybe next summer thing, something like that, and that bumped up almost $1,000 or $1,100 in cash flows if that scenario came true.
All right, so I'm running around 1150. As Mike, he made sure to preface this. I'm more of a conservative investor. I have lots of things here. Like I stated, I self-manage my properties. I still account for property management because I know I'm gonna be out of here within a year-ish. So I want to make sure to account for all that. In this scenario, we're gonna go 1150 for four units. Each unit's gonna rent for 1150. Ignore these because there's no more quantity left on them. But with the high reserves, we know maintenance and capex are gonna be realistically, we'll say 3%, which means you're saving 1,500 a month or 1,500 a year. Maybe that's a little low, but 1,500 a year on a property that's not really using any. In 3 years, you're gonna have almost $10,000. So you could account for if a roof has been replaced in the last 10 years, you're probably not gonna have to replace it for at least another 10 years, if not longer. Vacancy at 1150 a month in Fairbanks, you're gonna have no problem renting a property out to a good tenant at 1150 a month, in my opinion. I'd probably go for something more like 5%. Like realistically, I know those will get rented out very quickly based on that price because you can't find a freaking property, a 2-bedroom, 1-bath for 1150 a month, especially with this one said had a carport that was a little newer. There's not a ton of rentals available, especially if you time your rental time, well. So when you look at the pro forma, oh shoot, once you increase your rents to fair market value, once you account for all those reserves and all that, you're looking at around 10%. So because I know I can get this property with minimal work to 10% cash and cash return with like $870 of cash flow or 200 per unit, this is definitely something I would pursue. like without a doubt, but I would choose a purchase price that's maybe somewhere in between. So this is assuming all that. I wouldn't give them 100%. I would not give the seller 100% benefit of the doubt on my pro forma, because that's putting me at a disservice. I would offer, in this scenario, as a non-occupied property, I'd probably offer something closer to 350, maybe 345 with an escalation clause up to 360, because I know the worst case scenario I make pretty solid returns. And honestly, maybe you would offer 360, because in this scenario you can get up to 17%. So realistically, you have to know what you're comfortable with, what your goals are, and you got to balance between your initial analysis and your pro forma analysis. I veer more towards my initial analysis because those are the numbers that I've received from the seller. That's what I'm going to go with, because I'm all right with losing out on a property if I offer a little too low, because I know the alternative is to just invest in the stock market, which I'm 100% comfortable with. Not everyone is.